Hello and welcome to this video on capital structure ratios. How a business finances its operations, its mix of debt and equity, is referred to as its capital structure. Capital structure ratios, also called solvency ratios, tell us about this mix of debt to equity that the firm uses. It's important to understand our capital structure because as a firm uses more debt, it means it's taking on more risk. Debt is risky because you have to pay interest to the bank at certain periods of time. Equity is less risky in comparison because equity holders don't force you to pay dividends. Dividends are voluntary and only paid when there is cash flow available. So that means borrowing money and being forced to pay interest on that money is a riskier way of financing your business. So capital structure or solvency ratios are going to tell us about how is the business financed, what level of risk have they taken on, how are they using debt, and will they be able to repay their debts. The debt to asset ratio looks at our total liabilities divided by our total assets. Total liabilities are our debt divided by our assets to get the debt to assets ratio. It yields the percentage of assets that are financed by debt. A very similar ratio is the debt to equity ratio. The debt to equity ratio is the total liabilities divided by the total equity. Both of these ratios are going to tell us a very similar story about how the business finances itself. What is the proportion of debt to equity or debt to assets? For both ratios, a higher number indicates a riskier business. It means you've taken on more debt and you're going to have higher interest repayments in the future, and you're going to have more money that you're going to need to set aside to repay that principal in the future as well. The interest coverage ratio, which is also called the times interest earned ratio, tells us about how capable we are of making our short-term interest repayments. We calculate the interest coverage ratio by taking our net income plus interest expense plus income tax expense. This is also called EBIT, earnings before interest and tax. So it's the amount of money we have available before we've paid our tax or interest that can be put to paying off our interest expense. It shows how easily our profits can be used to pay off our interest. Again, a higher number here is better, it's safer. However, if you have a really high number, it means you maybe are not utilizing as much debt as you could. And if you do utilize more debt, remember back to our profitability ratios, it may increase your return on equity. So we want to be safe and make sure we can pay our debt. But if we're too safe, maybe it means we could utilize debt to increase our business at a faster rate. And finally, the debt coverage ratio is non-current liabilities, our debt, divided by our cash flow from operations. And this will tell us how long it's going to take us back in current year cash flow to pay off our long-term debts. So when you divide this, the debt coverage will give you a number which is equal to the number of years you would expect to pay off your debt. A larger number indicates more debt and a riskier business position. So overall, we've looked at these capital structure ratios, and we look at capital structure ratios in a similar way to how we look at liquidity ratios. We want to know, how does our business look in terms of its ability to pay back its debts? Liquidity ratios, we're focusing on short-term debts. Capital structure or solvency ratios are focusing more on the medium to long term. Can we pay off our interest? Can we pay back our debts? And how much risk have we taken on board? Thank you.